Greetings traders, my name is Timothy Hellberg. I've been trading for over 12 years now, mainly in FX. I've had a professional career in the industry, trading at some of, at the time, Northern Europe's leading trading desks. And at only 23 years old, I was tasked with setting up a whole new FX trading desk at a trading firm with direct funding from the largest sovereign pension fund in the world, the Norwegian Oil Fund. I trade manually and I own a fintech company focused on developing automated trading and analytics software. So I know my stuff, and today I'm bringing you the market report for week 8 in collaboration with IMGFX, the people's broker. IMG lets you trade over 200 different currency pairs and assets such as FX, crypto and commodities, all at really competitive pricing. Not only that, I've traded, as I said, for over 12 years now and used over 20 different brokers throughout the years. And the main reason why I love IMG is not because of their competitive pricing or great customer service. It's because IMG is actually the people's brokers. It's so rare finding a broker out there that actually puts the clients first. And at IMG, the whole brokerage is based on such a high standard of morals and values. That's like the only broker out in the whole industry that I personally feel comfortable with attaching my name to, and basically risking my 12-year reputation in the industry, and that says a lot. So at IMG, things just work. They work as they should, and I hope that one day IMG can become the leading example for the whole brokerage industry on how to do business. So if you're looking for a broker to trade with, check them out. In my opinion, they are the best one out there, no matter what asset class you're looking to trade. So with that said, let's jump into the market report for week number 8 of year 2022. So we are gonna run through a selected few different talking points. We're going to talk about the economical calendar for the upcoming week. We're going to talk about Bitcoin, we're going to talk about gold, we're going to talk about the Australian dollar against the Canadian dollar, and we're going to talk very briefly about the US dollar, and then we're going to end it off with talking about one underrated indicator that you might not have heard of that might give you better stop loss placement. So let's start out with the economical calendar. So heading into next week, the week starts pretty slow. We have some news in early morning Monday European time with European flash manufacturing and flash services PMI for Germany. Don't expect this to be too market moving unless they deviate a lot from the forecasting. But it's worth keeping an eye on if you got euro exposure. Keep in mind that Monday is a bank holiday in the United States, so we might see a slower trading environment basically. Tuesday, very slow, nothing really on the docket that will be market moving. Wednesday, Japanese bank holiday, so keep an eye out for that if you got Japanese exposure. Wednesday will bring some fireworks for the New Zealand dollar. Keep an eye out for this in the night European time. Rate statements are always one of the largest news events that you can have in Forex. So if you're trading the New Zealand dollar, keep an eye out for these. But I wouldn't really have a setup that you would go into these news at this point to trade it. It's more of a reactive news event where you either position yourself beforehand or afterwards. There isn't much to do based from an analysis point of view. Heading into Thursday, we got US preliminary GDP quarter on quarter. Once again, nothing huge. Keep an eye out for a big deviation from the forecast. That is the only thing that would move markets. We got an FOMC member speaking, could be worth keeping an eye on. And then Friday, we got a pretty light docket too. We got some news from the US, but overall, the calendar is pretty thin for next week. So Main focus will be on geopolitical news, basically Russia-Ukraine conflict, keeping an eye on that because that is dominating the news flow at the moment. So with that said, let's jump right into Bitcoin. So Bitcoin, we have an explosive pattern forming, or is it just a leveraged tech trade? So let me explain what I mean with that. What you have right here is the Bitcoin daily chart, and you have US Tech 100 daily chart. So basically this is the top 100 tech stocks from the US. If we compare these two charts, you will see that they move pretty much in tandem with each other, more or less. Bitcoin is more volatile, so when US tech goes up, then Bitcoin goes up, but not as but more aggressively, basically. So what I want you to keep an eye out for is the US tech stocks have put in a decent decline, and US tech always get hit hard by risk sentiment, and right now risk sentiment is all over the place with geopolitical risk in Europe. Bitcoin has started to follow, so this might be a bearish case on the daily chart to keep an eye out for. However, if we go up to the weekly chart and we only look at Bitcoin, if we look at last bearish correction that we had here, you can see that it resumed upwards here, and if we count these candles backwards, we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. So between the last bullish candle until the resumption of the bullish uptrend, we had exactly 11 weeks. If we look to where we are right now, you got the last bullish candle, and we have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, and then we got 2 bullish weekly candles. So before we got these 2 red weeks here due to geopolitical risk in Europe, we had a strong case for Bitcoin to make a new resumption for a new high. So what you basically have is that you have 2 charts to look at. So you have the daily and you have the weekly for the long-term prediction for Bitcoin. I don't have a trade set up for Bitcoin at this point in time, but if the geopolitical news in Europe simmers down and we see equities starting to pick up again, specifically tech stocks starting to pick up again, then you could look for this to reverse. Right now, with Bitcoin and the tech stocks basically diverging from each other, I would stay out from any long-term trades on Bitcoin, but it's definitely worth keeping an eye on if the geopolitical risk subsides in Europe. Next up, we have gold. So basically gold is, as it seems right now, the war hedge, but only to a certain point. So what I mean with this, let me show you, is basically we've had this pattern forming, a classical wedge on a higher time frame. This is the weekly chart, and we've broken out of it. Gold broke the 8-month high, and we've broken out of this. So as it seems right now, there is a strong case for gold being stronger based on the geopolitical risk in Europe, but there is also a strong case for gold being stronger based on what the market was focusing on before this whole Russia thing began, and that is inflation. So I'm not going to jump into that because then I could talk for half an hour about that. Maybe we do that in another market recap, but basically the fundamentals are aligned right now for stronger gold versus the dollar. So what I would aim to do if I were you is that, or what I'm doing, I should rather say, is that every single lower time frame, depending on what suits your trading style. For me, I would go from 1 hour all the way down to the 5-minute, and I would look for technical entries. How I would do it is basically through divergence. So I would mainly look for basically some kind of momentum trigger for it to enter, whether it may be divergence in RSI, whether it might be divergence in MACD, whatever indicator you might use to get your entries on lower time frames. But I think gold has a really good potential to just either scalp on lower time frames or just cost average your trades, add to your long gold positions on the pullbacks. That's what I'm doing. So this would be a great pullback, and then we add to it. This would be a great pullback, then we add to it, etc., etc. That's how I'm trading gold at the moment, because we are getting these risk sentiments. You know, you get news out of Europe that things are subsiding, Russia is pulling back, etc., and we get these major reactive candles, and it's just perfect to enter and just add to longs at a better price. But some might say, well, won't you be stuck in long trades then when and if the Russia conflict just nothing happens? Yes, but that would just be temporary, because as I said, the inflation trade also brings a strong case for stronger gold. So if you feel comfortable holding gold for a longer period of time, now might be the time to do it. Next up, Australian dollar against the Canadian dollar. So I call the Australian dollar against the Canadian dollar the perfect oil trade. Why do I do that? Well, it's actually pretty simple. So Australian dollar is extremely risk sensitive. Oil is also risk sensitive, but it's also production sensitive. If Russia and Ukraine goes into an armed conflict, then oil prices have a case for being stronger, as Russia, being a big producer of oil, would have problems exporting their oil and due to sanctions, and for that reason the demand for oil from other producers would go up, and that would bring up the oil prices. At the same time, risk sentiment would get hit hard, and so essentially the Australian dollar would get hit hard. So the Australian dollar against the Canadian dollar is basically you're shorting risk against buying oil, which is the perfect oil trade in my opinion. We have this structure on the higher time frame chart, the daily chart, and I'm still looking for a bounce of these support levels up towards this trend line here, and anywhere between here I am comfortable adding shorts into my portfolio basically. So I don't mind this pushing up even higher on news. I actually like it because I just get better entries, but I like to trade from a risk perspective, and I like to trade from a technical perspective. So both the fundamentals and the technicals align. If we don't get this push, it's the same case as with gold. I would look on the lower time frames or whatever kind of entries that one would use, whether it might be divergence, whether it might be any kind of momentum indicators, however one would trade. For me, I would look for divergence in price action towards RSI or MACD basically. So lastly, the US dollar, patiently waiting. Well, yeah, let's see. The US dollar is stuck in a consolidation. It's very easy to see on the weekly chart. We could go higher, we could go lower. We are just moving back and forth inside of this. I wouldn't say too much about the US dollar until we break out of this consolidation, upwards or downwards. That's the case. But if you want to print screen this and put this on your chart too, to have some kind of directional bias and watch for a break higher or lower, that could be a good plan to do. So lastly, let's talk about an indicator that you might have heard of or you might have not heard of. So this indicator is called basically ATR, Average True Range. Average True Range was firstly an indicator developed to be used in commodities. So basically it's a measurement of market volatility, and it does this at a pretty complex calculation. If you want to take a look at it, you can just Google average true range, look up on Investopedia, and they will show you the whole explanation of how it's calculated, etc. But what you need to know is that it measures market volatility. It was firstly developed for commodities to be used with that, but it works on all markets. And how can you use this to get better stop loss placement? Well, if we jump on a lower time frame here, actually let's go on a 5 and see if we can find a divergence trade somewhere here. As you can see here, these two red lines here are a proprietary indicator that I use. I had developed through my fintech company, where it plots divergence automatically on the chart. So here we had bearish divergence being put in, so we would look to short in this price range here. So where do you put your stop loss? Well, that's always the thing. Some might look for you might look for a previous swing high or something like that to place your stop loss against. However, it's not always that you have a swing high. So in this case, we don't have, especially on low time frames, we don't have a swing high because we are coming off a bullish trend. So you don't have a top to base your stop loss against. So are you just going to go on percentage, or are you just going to go on a fixed set of dollars in gold? None of that is really optimal. You want to place your stop loss somewhere where statistically you're out of harm's way in terms of the market, and that's where the ATR, as you can see down here, really shines. So let's just change this into something that is brighter and easier to see. When we got this trigger here to enter the trade, we can look at previous ATR highs. That's what I would do. So you look at these highs here, we are around 2.45, and these highs here are around 2.70. If we scroll even back, okay, so that seems to be the highest points in previous trading. So as we don't have a swing high in price action to trade against, we have to use something else to trade against. We use these two swing highs in ATR. So it's telling us, okay, the ATR 2.70 seems to be the highest. It's telling us that the average true range is $2.70, meaning that if we place our stop here at $2.70, which would be here, around here, then we are inside the highest basically level for the latest volatility that the pair has experienced. However, I would go wider than that, and this comes down, especially if you're on such a low time frame as this. So you could, for example, you could do this times 2 or times 1.5, or you just have to find something that works for your strategy. In my case, you would just take $2.70 times 2, that's 5.4, that's your stop loss value. So you want a 5.4 stop loss. So on a currency pair like, for example, euro dollar or similar, I would use the 1.5 calculation. And on a commodity like gold, I would use a bit of a higher calculation, like 2 or 2.5, just based on volatility. You would clear that, and you could, depending on whatever you would go for in terms of a 2 times risk reward, you see it would hit over here. So using the ATR when you don't have price action to trade against, and using those highs instead, gives you a good idea of staying outside of the risk zone for volatility. And using this in combination with price action could also give you a better understanding of keeping outside of the volatility of a currency pair. So with that said, try this out. Look on your own trading strategy, see if you can implement ATR, test it back and forth and see if it gives you better entries or not. And from that, see if you can get better stop loss placement and more profitable trades. Let me know down in the comments if this is something that you're using right now, or if you have tried it before, what your thoughts are on it. Maybe if you have another indicator that you want me to run through on next market recap, I can do that. Until then, stay safe. We have a lot of geopolitical risk trading, so stay safe. Use a reputable broker like IMG, and I wish you all a profitable week. That's it for me. Thank you, guys.